good evening to everyone, and welcome to the second series of Decoding Markets. Today, we're going to talk about an asset class which is universally accepted and has great marketability irrespective of its geographies. I'm sure you have guessed it right. We are talking about gold. And to speak and give us much more insights into the same, we are joined by Mr. Vikram Dhawan. Mr. Vikram Dhawan is the Fund Manager-Commodities at Nippon India Mutual Fund, and he is a veteran with over 2 decades of experience in fund management, commodities, enterprise management, so on and so forth. He has also worked with Gold Matrix Singapore before joining Nippon India Asset Management Company. Welcome, Vikram, and many thanks for joining us today and speaking to our investors. I'm sure we'll have a lot of takeaways post this discussion. So before I get into these specifics, I would like to start with the most fundamental question, which is about past returns. So, I think the only asset class which has a history of more than 50 years is gold. So, can you help us understand how gold has done over various time periods across market cycles?
Sure. Thank you very much for inviting me on this call. I hope all of you are doing good and safe, and so are your families and your acquaintances. So yeah, I mean, gold has a track record, a very long track record. It was the first known universally accepted currency. Actually, silver also was universally accepted currencies thousands of years back. So as I would like to say that, the track record of gold is into hundreds and thousands of years, which probably, outlasts the track record of most funds and most fund managers. So it's a very formidable long-term track record which gold has. But I think if you talk about recent history, I mean, humankind, we probably would like to speak more about post-World War, the two world wars. And, obviously, till the early 1970s, the gold standard was still into play. And I'm sure all of you are aware what gold standard was, but just to refresh your memories, gold standard meant that, the central banks, the amount of money they could circulate was limited to the amount of gold they were holding. So that gave a credibility to the currency. So, early 70s, US was the last country to be, honoring gold standard. And but they abandoned it primarily because of two reasons. First of all, as you can see right now, today the world is being saved by the printing machines of the central banks, which you cannot do if you have a gold standard because the amount of gold is limited, whereas you can print unlimited amount of money. It's as per the requirement of the circumstances. So that was one reason why, especially in deflationary cycles, the central banks were restricted into amount of money supply they could increase. And secondly, the Federal Reserve or the US Treasury was holding, some very high quality bars, which most of them had, antique value also. So all you had to do was, get hold of a dollar bill and you could exchange it for that amount of gold, very high quality bars. So they would actually run on the stocks of the central reserves, the reserves of central reserves. So that's why primarily for these two reasons, it's the discontinued. But since then, and they were the last ones, prior to that in the 1925s, the UK central banks also abandoned gold standard. So, so probably in the early 70s, gold was abandoned or orphaned by the central banks, which were the largest subscriber to the yellow metal as a single group. Even since then also, after being abandoned and orphaned by the central banks, gold has returned roughly about 8 to 10% over a longer period of time. So this is more in rupee terms. And you'll have to appreciate one thing, that the Indian rupee data and the Indian gold data doesn't go that long, because it was only in the early 2000s that we actually had a commodity exchange, MCX, where you had listed prices of gold. So this is all derived data. It could be off by a few percentage, but roughly you can say, all the figures are rough basically, So roughly, gold over a 50-year period gave a return of 8 to 10%. That kind of return was also achieved in the last 20 years. On a 10-year period, it was slightly less because you had these 3 years, 12, 13, 14, where gold actually went into a bear market. But that's still about 6 to 7%. And we know what gold has done in the past few years. So 5-year returns is in double digit, 10 to 12%, and 3-year returns in excess of 15%. And, past 1 or 2 years, gold has given in excess of 40, 50%. So this is, again, as part of mutual fund industry, we have to warn you that past returns are no guarantee of the future performance. But this is a very formidable, a very hard to ignore, return track record. And while there's no reason why, these kind of returns can be expected in the future. But I think one thing which I would like to caution you, that post every financial crisis, especially the post 2001 and 2008, we have seen normalization of returns in most asset classes. So it may mean that the future returns in most asset classes like equity, bonds, and commodities may taper off, and we might see a similar phenomena in gold as well. So if you are looking, if you are expecting around close to 8% return over a longer period of time, then there is a chance that you will not be disappointed. And in times like these, you'll get a very, very massive, pleasant upside surprise. Yeah.
Thanks, Vikram, for taking us through the nature of the gold for last few decades. Now, the next question which comes to our mind is that on one hand you mentioned that gold standard is no more relevant in the world today, but on the other hand, if we see, and it is basis your interaction with us in last few interactions, you mentioned that 2019 rally was primarily on account of central banks buying gold, so be it China, be it Russia, be it India. So what is the reason for institutions like central bank, which are very, very important which have become very important in the last 10 to 12 years, to rely so heavily on gold? And if I remember, you also mentioned that today central banks own around 40% of the overall gold which is there in the world today. So what would be the reason for central banks to have this huge amount of gold and still trying to accumulate further from here? And second part of the question, which to some extent you answered also, is whether it is a structural story or it is a cyclical story. So if you could answer these two parts, maybe it will help us understand better.
So I think in 20 years, gold has come a full circle. Late 90s, during the so-called the Asian crisis, Asian currency crisis, where the so-called tiger economies, just simply collapsed as they ran out of, they had raised a lot of hot money in terms of dollars, and when that money started going back, there was a currency crisis, and that led to a global crisis as well. So at that 20 years back, the thinking of central banks was, it's like, let's dump gold and buy dollars. So that happened till the early 2000s, 2003 or 2004. So the mantra was that, instead of gold, keep dollars, because, see what happened with the Asian economies in the late 90s. And, but then what happened is that, dollar invincibility has been questioned in the past, a decade or so. And secondly, you have, other currencies which have come in, like euro. Obviously, euro is no match for dollar even now. But I think you have, for instance, the Chinese yuan, renminbi, which is, it's not 100% convertible. So, what do you do, if you want to have access to currencies which are, even rupee also is not fully convertible. So what do you do, if you want access to currencies, which are not fully convertible? Because if you have a lot of reserves which are in currency which are not freely convertible, then it may happen that you need the money. The central bank may need money, like as of now, and you may be sitting on currencies which are very hard to exchange for anything. So one way of doing it is to build more dollar reserve, and convert whatever currency into dollar with the dollar, and keep it whenever you need it. For instance, if you have a strong bilateral trade with China, so you would need some sort of reserves of yuan to manage that. The other way is to also have gold in your portfolio, because gold, see, one thing which not many people are aware, that gold, there are various markets. There is the biggest market is LBMA, London Bullion Market Association, where the daily turnover is into hundreds of billions. There is COMEX, the mercantile exchange in New York, And obviously you have a Shanghai exchange, you have an Indian exchange as well. But what people don't know is that there's a very, very large, very liquid interbank market where even central banks are also buyers and sellers and borrowers and lenders. So it's a very large, it's a very liquid market, gold. And I think in terms of liquidity, it might be next to only dollar. It's probably as liquid as any major stock index or any major currency treasury. So which is saying a lot for gold because it trades in various markets, and there's also a very large physical market also. So it's obviously it's a proxy, a good proxy for dollar gold. It's extremely liquid. I mean, whenever you need, for instance, what's happening today, we have situation in a country like Venezuela. They run out of dollars and they are under strict sanctions by the US. So they are using their gold reserves to buy the essential things. Obviously, there's another dodgy country on the other side, Iran, which is doing a trade with them. But yes, either you have gold or you have dollars. If you have either of them, you'll be safe. Also, the other important aspect of gold, which people don't, appreciate too much, gold doesn't come with any credit risk. It's not any sovereign liability. So in times like this, obviously, there seems to be some sunlight now, whereas it's in the month of March and April, it seemed that, you could have a domino effect of credit downgrades. And incidentally, we also got downgraded yesterday. Credit downgrades and credit defaults. So in that kind of time, you would want to hold gold because it doesn't come with any credit risk. So I think it's the safety, it's the liquidity, it's the interchangeability with the other currencies. It's also, it's a hedge against the dollar because at any point of time, the currency markets have been very forgiving to the US. They have been goofing around, it's like the amount of stimulus in 2008 and amount of stimulus now, it's amazing. I mean, even if any other country would have done a tenth of this kind of stimulus, the currency would have gone for a toss. So yeah, despite of the US goofing around with the currency, the market is still, very, very, forgiving. But I think at the back of the mind, central banks are traditionally very, very risk averse. So I think they would want something which is sort of a counterbalance to the dollar. So yeah, so these are some of the few points which why the central banks just love gold. Okay, so ideally gold should not be a structural story. Why? Because it doesn't pay you any dividend or any coupon. It doesn't have any duration or anything. That is really baffling for the world, especially people who are not involved in the commodity market, especially the equity and the bond investors and fund managers. That how come something which doesn't give you anything? Even Warren Buffett used to call it, it's always looked down upon gold. So it should not. But the reason why it does is because if you look at the history, post every financial crisis, you may call it stimulus or you may call it increase of debt, whichever way you want to see it. There has been increase of the exponential increase in money supply or debt post every crisis. Now, one way to look at it is, one argument is that, whatever stimulus is given in the system is never withdrawn, which makes a bull case for equity. The reason why equities are, risk assets are rallying today, because they've seen what happened in 2008. Whatever stimulus was planted, still not been, retrieved. And they tried to retrieve in 2011 and 15 and see what happened, that so-called taper tantrum. Similarly, the world expects that this stimulus of $8-9 trillion is not going to be recalled. At least not in the near term, if at all. So that is one way of looking at a bull case for risk assets. The second way of looking at it is the amount of debt. And I think, unfortunately, the world has found the cure for debt. And unfortunately, the cure for debt is more debt. So we are getting more indebted. Whether you want to call it Japanification of the world or Italification of the world, whichever way you want to look at it. But we are going towards a world, we will be waking up, once the COVID crisis is over, we will be waking up in a world which will be a lot more indebted, significantly more indebted than it was before the COVID crisis. And what it does is, it can, put the world into either a deflationary spiral or an inflationary spiral. So if too much of leverage, too much of debt fueled recovery, inflation, too little, or if there's an attempt to retrieve it, it could be a deflationary cycle. In an inflationary cycle, Gold has got a very good track record historically. Whenever inflation has come, gold and most other commodities are the things to hold. Hard assets are things to hold. In case of a deflationary cycle, you might have huge problems in the credit market. There could be a lot more defaults. And as I mentioned, that one of the things which one of the attributes of gold is, doesn't have come with a credit risk. So yeah, but then there is a third scenario also where the central banks, maneuvers all through this Goldilocks, path where we are neither hit by the deflationary forces or the inflationary forces. But 2 out of 3 scenarios are actually crying out loud that one should have gold in their portfolio. So unfortunately, it is the imbalances in the world, whether it in the form of excess debt, whether in the form of inflation or deflation. These are the imbalances in the financial markets across the globe, which has actually fueled a need for something which is largely unaffected, or rather gets tailwind out of it. So that is why I think gold story will remain structural for at least in the foreseeable future.
So Vikram, that's very well explained, why central banks own close to about 40% of the total gold reserves. So if I was to just ask a quick question on, who are the other major beneficiaries who own gold, and maybe a ballpark number in terms of, the major owners of gold in terms of percentages?
So beside the central banks, it's the funds, the ETFs, which hold, as of now, they're holding anywhere between close to 5,000 tons in physical form. But, there are funds which also invest into gold derivatives, which are, derivatives are all deliverables. So I think if you want to keep a percentage, I would say close to 10% of the gold will be held by the next largest holder of gold would be the gold funds, which would be over 10% by the various forms of funds. Also, I think goes without saying, it's beyond the capability of a normal mortal to hoard gold bars beyond a certain point of time. You will have a lot of trusts, you will have a lot of family offices that we come across, which irrespective of their geography and their cultural affinities, have been investing into gold in various forms, either physical gold or gold funds or whatever it is. So yes, a lot of large institutions, a lot of pension funds across the world. Again, that will be formed as part of the funds, but a lot of large trusts and lot of ultra HNIs and a lot of large family offices also hold a big chunk of it. Very difficult to quantify the figure in that, but I would say that would be fairly decent. Close to 5% or even maybe higher. These are the largest holders of the gold. And also, I mean, I've been in the industry for more than 2 decades, and there's always a standing joke that in the times of crisis, the Indian ladies, Indian women who are allegedly the largest holders of gold as a group tend to outperform everybody, including Mr. Warren Buffett. So that is also one group which is biggest holder of gold in the world, with due respect to Mr. Warren Buffett.
So Vikram, you rightly said about the outperformance versus the biggest investor, the most the smartest guy on earth in terms of investment. So
Yeah.
that gives us a very strong reason to make gold as a part of asset allocation. Now, out of 100 rupees or $100 of an investor's, which is going to be in riskier assets, how much should be the gold in that? I mean, should we look at an absolute percentage, or it should be linked to a percentage of the equity which an investor would want to have in the portfolio? And what does it do to the portfolio? I mean, does it reduces the volatility or it enhances the return? So basically what I'm trying to ask is 3 questions put into one. What should be the percentage allocation in gold? Second, does it help in generating alpha, or does it reduces the volatility in the portfolio?
Sure. So I think, again, one of the most understated attributes of gold is liquidity. You can imagine in the month of March, if you had to sell something out of your portfolio to raise money, I think if you were lucky enough to be holding gold, then you would have been able to, raise money for whatever, covering the losses or, contingencies or covering margins or whatever it is. So liquidity is a very important attribute of gold. And I think this is the starting point for every investor. Now, what part of your portfolio you always want to be liquid and solvent, whether it is 5%, 10%, 20%, that is each individual's call. And let us say, suppose for an example, that comes to 10% in a particular portfolio. Then out of the 10% should be divided into short-term debt and gold. Again, you can, play around with the 10%, whether it is, 5.5 or 4.6, that is something which is immaterial. But I think anything less than 5% in the portfolio will not give you any sort of, a hike in the risk-weighted return. So that is the bare minimum one should hold. Secondly, I think the most important aspect is that what is the, the expectation, what is the investment objective of the investor, whether he is taking gold in his portfolio as a tactical play, whether it is something for absolute returns, or whether it is purely for diversification or hedging. Now, as far as the tactical play is concerned, I think mutual funds are the worst places to come for doing any tactical play. You're better off going to the exchanges to buy gold and sell short-term, weekly, daily or monthly basis. Now, as far as the absolute return is concerned, now in that case, it has to be a carve out of your debt portfolio, because gold, as I mentioned, historically has given debt plus returns. So that is something that you may consider, as a carve out of your debt portfolio. From the point of view of hedging, diversification, I think the most important aspect is that, what is the skew of your portfolio? Is it something which is, just to take one parameter, if it's a high beta portfolio or a low beta portfolio, or it's more skewed towards debt or more skewed towards equity. But I think, various studies have been done on that. One of the recent studies was done by World Gold Council, and they came up with this figure that if a typical Indian pension portfolio, which aims to generate in excess of 9% over a longer period of time, balanced portfolio, in that portfolio, they added gold, at between 6 to 17%. And they said that if you add gold, well, roughly you can take it as 5 to 15%. If that amount of gold was added into this portfolio, purely for diversification, it not only enhanced the risk-weighted returns, or rather it decreased the volatility of returns of the portfolio. It also enhanced the overall returns also. So I would say that, there's no magical equation to do that, but anything between 5 to 15% is optimum. It also depends upon, how much liquidity you want. That should be the bare minimum, part that you should keep in gold or short-term debt. And again, what is the skew of your portfolio, whether it is more towards debt or equity, high beta or low beta. And, last but not the least, I think it is also very important to, understand which part of the cycle you are right now. So for instance, if you are, right now we are sitting on phenomenal returns in gold, then it's better to spread your bets over a longer period of time. So just to give you an example, that the last peak of gold was way back in September 2013, where gold made a high of 3,500 rupees per gram, or 35,000 rupees per 10 gram. Even if somebody was unlucky to buy all the gold at that point, you would have still got 5-6% returns. But again, that person, if he or she would have spread the bets over 6 to 18 months, then they would have got double-digit returns. So in a nutshell, yeah, unfortunately, there's no magical equation for this, but this is what you should consider while putting gold in your portfolio.
Right, Vikram. I think you put it very well. How for a return, how for a risk hedging portfolio, you need to kind of have allocation towards gold. Now, coming into the macros of gold price, what we probably see on our screens is maybe say like today's closing at 47,000 for 10 grams. And I'm sure there are various components which, add up to make it 47,000, right? You have your London spot exchange rate, you have, your rupee dollar conversion rate, you have, your customs duty, etc. So can you explain to our investors what are the various mix and how they benefit from each of the components in adding to their total returns as far as gold is concerned?
Gold in India, for that matter, any country would, the landed price would include the import duty. And also after the conversion into the local currency. So you take the LBMA price, London Bullion Market price, Queen price. They also have a fixing price, which is AM and PM fixings. So most of Indian funds for the AM fixing of LBMA. And you take that, you convert it into rupees, and then you load custom duties on that, and that is your landed prices, and that is what MCX also would trade that. After GST coming in, it's only GST which is applicable if you're actually buying or selling that gold, but that is included in the screen price of now. Whereas in the funds, it is included in the NAV of the fund because it's something that we have paid. It's useful for us. So that is as far as the price is concerned. Here, I think the most important aspect is that the rupee dollar rate also plays a very important. So when you're taking a view on gold, you should take a view on the rupee dollar rate. What is your view on the currency? At which part of the cycle the Indian rupee dollar is now? Although historically rupee has been over 3% annually over a longer period of time, but yeah, this is years when rupee is actually appreciated also. When the cap have overshadowed our current account deficits. But India remains chronically current account. Unfortunately or unfortunately, right now we are having a surplus because there are no oil imports and gold imports. But I think once things go to normal, there will be a current account deficit. And so it's very important to view on rupee dollar also once you're buying gold. Also, I think from the point of view of landed price, you have to remember whether it is India or any other country, each country comes with its own location for discount. It's no different than steel. So, steel prices in India, the same stuff may have a slightly different price than it may have in Japan or China or US, because you always have local demand forces which play into the locational, as what we call as locational premium or discount. For instance, in the month of March, there was a shortage of gold bars. There weren't any gold bars available for love or money. In that case, the physical market in India, in fact, our funds also were trading at a 5% premium. And now that that blockade, the curtailment of production is opened up, so now we are almost at par at the London bullion market. The reverse can also happen. If there's an oversupply of gold in the market, you'll see the physical market actually at a discount. Yeah, so there is, the LBMA price, the rupee dollar conversion, there is custom duties, and there is also the locational demand supply or locational discount or premium which come into play in gold pricing.
Understand, you mentioned about jewelry being held by, Indian household for a good number of years. And I think, the question which I'm going to ask you would not have been relevant a couple of decades back, because jewelry or physical gold was the only way of holding the gold at that point of time. But today, with a lot of digital tools available and it becoming, electronic form of gold being available to us. So if somebody is looking to invest gold, not for a trading strategy, but more for an investment strategy for say 2 years, 3 years, 4 years, or 5 years, what would be the pros and cons of maybe a gold fund versus a physical gold, or gold fund versus an ETF? So what would be the desired way of allocating the gold for somebody who's looking to invest into gold for 2, 3, 4, 5 years kind of a time horizon?
Sure. So I think as fund managers, we tend to look down upon jewelry, but the reality at home is something different. I think that is where the gold has to be bought first than in any other form. Buy jewelry, buy physical gold, but because that is for your consumption. There is gold is also a consumption story, though gold is also an investment story also. In India, it is unfortunately 80% consumption and 20% investment. Hopefully it will change as we go ahead. So yes, buy jewelry also, because I think gold bars and jewelry will look a lot better when you see them vis-a-vis your share certificates or your bond certificates when you have a look at them. But don't buy it don't buy it as a form of investment. That is purely for your consumption, purely for your own personal needs. Primarily because gold, which many people don't appreciate, is most illiquid in its physical form. Because unless you are holding hundreds of kg of gold, the bid and ask spread on physical bars can be massive. It can be as high as 5 to 10%. You can imagine, carrying an 8-gram coin to a bullion dealer in anywhere in the world whose ticket size is, let's say, 10 million or $5 million, and probably you'll have to go to a sub dealers who will be adding that many layers. So don't expect your jewelry to be an investment. It's something, if you have to sell that, you'll probably lose 10, 15, 20% out of that. It's a bad investment. Same for the gold bars. And also for gold bars, after we saw what happened with JP Morgan, where they were, uh, due to, whatever reasons, they ended up holding some bars, gold bars, which were of dubious nature, not in terms of the purity of the bar, but the source of the bars. So I think if you're holding a gold bar and if you want to dispose it off, you need a certificate, it's a bit of a bother holding those gold bars also beyond a certain point of time. And the smaller the ticket size in physical gold, the more illiquid it is. So unless you're holding gold worth 50 to 100 crores in physical form, you will be really mauled by the bid and ask spread. Then you come to the gold derivatives, which are traded in the exchange. That is purely for, as I mentioned, for traders. Only a humbling advice to traders is that today 80 to 90% of the volume in every exchange across the world, whether it is commodity or equity exchange, is driven by AI platforms. And on an average, these AI platforms invest into millions, if not billions of dollars into their software. So just check your odds, what you're up against. But you still can make money, then you're really very good. Then you have the gold bonds and you have the gold funds. Now, for investors who are buying gold purely from the point of returns, then gold bond is a excellent vehicle because it will give you gold plus whatever 2.5% returns over a longer period of time. But you'll be missing one very important attribute of gold is liquidity. So, for instance, if you want to dispose them off, there isn't any liquidity as of now, because if you check the liquidity, whichever exchanges they are listed, it's not worth you talking about. But as far as the gold funds are concerned, if you are a serious investor into capital markets, if you're someone who believes in creating wealth out of capital markets, bond is the only option, because even if you are a very, very long-term investor, there will be times, quarters, and at least few quarters or few years where you will have to rebalance the portfolio, simply because you're seeing high inflation, you want to, shift out of bonds into equities and more gold. If you see inflation, you want to shift out of equities into, there will be some rebalancing of your portfolio happening. And gold funds are the easiest to rebalance in your portfolio. Very efficient, hardly any bid and ask spread, and it's the same platform, the same mutual fund platform. Just a click of the button, you can reallocate your portfolio. So yeah, so it depends, what is your objective of buying into gold, and that decides the instrument that you should hold.
That brings me to the next question. So SIPs are a traditional but often an underrated way to invest. For a new investor or maybe an investor in mid-30s, would you recommend investing in gold funds through an SIP route?
So I think if you see, even from a mathematical point of view, that typically what happens is that when the markets are more volatile and not going anywhere, that's what we have seen gold in the month of whole of April, so in a situation, and we are also at all-time high in rupee terms, way beyond the previous peak. So I think, like every other asset class or security, gold will have a bear market, a bull market, and a sideways market. So I think you have to be very conscious of the fact that which part of the cycle you are. Historically, if you see, gold has literally taken off after each crisis, whether it was 2001 or 2008. 2001, 6-year bull run, 250% returns. 2008, 3-year bull run post the crisis, 170% returns. So we have not even started if you look at the historical precedents. But like every crisis is different, and there's no guarantee that this crisis will be the same as previous one. So I think some part should be put in the SIP, especially if the market is going to remain volatile. You might actually outperform the market if you're during volatility if you're doing SIP. Also, I mean, irrespective of your view, it always helps to spread your bets at least 6 to 12 months, if not more. So, I mean, you always have the option. That's the beauty of mutual fund. You always have the option of halting your SIP and buying lump sum if there's a huge correction, or as I tell everybody that if you made good money in anything, I always quote the example of one of my investors who's sitting on 60% returns in past 1.5 years. So there's no reason why you should take some money off the table and book profit and probably frame it as well. So yeah, for you it's very important to spread your bets. It's very important to be conscious which part of the cycle you are. At least some part of it should be through SIP for sure. And the good thing about SIP is that you directly approach the fund house. You don't have to go through the market buying units or selling units as the case of ETFs. So there you come for investment, and for redemption you come directly to the fund house, who will give you liquidity all the time. So that is also a benefit of an SIP.
So Vikram, you have answered, how one should buy and which all avenues one should use to buy. Now that brings us to the last question on when to sell, because investors often ask us with respect to a particular debt fund, equity fund, or even gold as to when to sell. And in equity, it's fairly simple for us because we can understand the future growth projection, and basis that we can make an estimate whether one should stay put in that particular equity or one should switch to something else. So is true for debt market also, because some idea about the cycles get played out by different institutions, be it central banks, be it about body language of the government, be it about the borrowing calendar. But when it comes to gold, how do we understand? Because there is no underlying coupon, there is no earning growth expectation. So when to sell? I mean, that's a very, very tough question. And without having sell discipline in place, I think buying can be futile and it can be speculative at times. So what would be your suggestion for someone who's not definitely in the camp where you mentioned that somebody made 60% in last 1.5 years? And you're advising that person to exit, that we do understand. But for a linear return generating portfolio, when should one take a call that I should move out of it now?
So I think the biggest red flag for gold is when the central banks across the world will start recalling the stimulus, and it may result in the spike in the yields, bond yields, without any inflation. So, and if you have the in a situation where the bond yields are leading the inflation, then the appeal of gold goes down. But if the bond yields are lagging the inflation, then the appeal of gold goes up. So this is the first first signal for you to start reducing your gold holdings. Spike in yields, obviously it should not be on back of default also. So it's like tomorrow, if the stimulus is being unwound for positive reasons, there is space, or there is the climate and the circumstances where the central banks can reduce their balance sheets, then this is a very important signal for gold that it might stall. Obviously, I have to qualify that we have to see what else is happening in the world also. But yeah, this is broadly the most important turning point in each gold cycle. Secondly, I think there will always be short-term, or rather medium-term corrections in gold when there will be the physical demand will lag the prices, like what we're seeing right now. The Indian and Chinese demand is all but collapsed because of the lockdown. Again, we don't know when lockdown opens whether the Indian Chinese will buy more gold, less gold, that much gold. I mean, if you look at the West, the physical demand in the West is at all-time high, whether it is US or whether it is Australia or whether it is Europe, it's all-time high. I mean, in the month of March, the small coin sale in the US was some 10 years high. So whether the Indian Chinese consumers will, follow their Western counterparts, or whether their backs will be broken so much by the COVID crisis that they won't have the purchasing power, irrespective of whether they like gold or not. So that physical demand is the second signal. Um, Typically, I think also over a very longer period of time, gold will have inverse correlation with the US dollar. But recently, we have seen a breakdown of that relationship because, in 2000, and this happened as recently as 2019 when China decided to diversify, to de-dollarize the assets, irrespective of, it's more of a political and geopolitical thing of the central banks, de-dollarizing their assets more than a view of taking a view on gold. So yes, these points are definitely a starting of a correction or end of a bull run or maybe starting of a long period of consolidation. Again, you have to be seen in context of what is the inflation at that point of time, what are the credit risks, and what is the economy doing. But yeah, broadly, these are the points which should, raise a red flag for gold prices.
So that brings me to the last question, Vikram, which you very candidly agree to answer for us while we were discussing before, is, a short-term view. And I'm sure a lot of our investors would be very interested to understand that.
Yeah, I mean, I like to protect myself with a quote from Ben Bernanke, the man who was credited with saving the world in 2008, the man who also invented helicopter money, and he used to always say that, I don't understand gold prices, and I haven't met anybody who understands it either. So you can take my views with a pinch of salt. But I think, first of all, there has to be a consensus that are we in the gold bull run? By all standards, yes, we are in the middle of the gold bull run, and the common sense suggests that unless the bull run is, that's the thing that we've been reading since in textbooks, since when we opened our eyes and ears in the market, till the bull run is over, it is not over. So if we are in the middle, if first of all the investor is convinced we are in the middle of the bull run, then there are two scenarios which may unfold in the next few months. As I mentioned, that there is a weak physical demand from traditional sources, which is India and China, although it's more than compensated for the higher physical demand in the Western hemisphere, and also a very extremely all-time high investment demand. So far, Indian-Chinese lack of demand is not doesn't matter right now in prices, but it will at some point. And I think what may happen is that if in a scenario where the physical demand creates a significant headwind for the gold, you might see gold correcting and consolidating in the next few months, and then towards the end of the year, it will attempt the all-time highs of $1,900 plus per ounces. I don't know what it will be in rupee dollars per ton, but that's about 10-15% from higher from here. That is scenario one. Now, in the case where the lockdown opens, then there is a pent-up demand for physical gold. Then you may not see a very significant correction. There will be a very shallow correction, maybe 5% or at the most 7-8% or 10%, max. And then you might actually see the prices challenging the $1,900 per ounce to begin with. But I think at that point of time, we're already at 40-45% past 1 year returns. If something like this happens in the next few months, then you'll be sitting in like 60-70 or 80% annualized return sort of a thing. So maybe that itself is a good time to, I mean, it might go to 100% also, who knows? But I think that also will be a good time to, put some money off the table. Also, whilst in the bull run, if you see in the first scenario, if you see some sizable correction, it will be a good time to buy, because historically, whenever gold has corrected during the crisis, whether it is 2001 or 2008, it has always been an excellent time to buy. And also one more attribute of gold, which I'll share with you, that whether it was 2001 year crisis or 2008 crisis, gold prices bottomed out before equities. In 2001, gold bottomed out a few months before Dow Jones, and then it embarked on a bull run. In 2008 also, gold bottomed out few weeks before the Dow Jones. And even in 2020, in the month of March, gold actually bottomed out 10 days before, week or 10 days before Dow made a bottom of 18,000 plus. The gold has this, it's a lead indicator. Not many people know that the worst is over. And again, I mean, we don't know whether there's another equity sell-off lurking somewhere into 2020. If that happens, then if there is a crescendo of deleveraging, second phase of deleveraging, then gold will also get hammered because people will need to raise cash. Somewhere they will sell gold. But so far, the activity we have seen in the month of March is that gold bottomed out, as it has done always in the past, before the equities, and it is, rallied after that. So, keep that these historical references and context in mind. And till the time the bull run is intact, at least the investor is convinced the bull run is intact. The corrections in the crisis time are the best time to buy gold for a long term.
Thank you, Vikram. Thanks a lot for a very, very elaborate and detailed presentation. And when we started this discussion, our idea was to understand about gold, but along with gold, you have given us perspectives about a lot of other asset classes and how they are interrelated. So my key takeaway from this discussion is about the behavior of gold, on the inclination of central banks toward gold, how for an investor one should look at when to buy, how to buy, and when to sell. And on top of it, you have enlightened us on how it is correlated to equity, and that's a good perspective which we never thought of. So to end the conversation, I would just quote JP Morgan that gold is money and rest everything is credit. And today your inputs have reinforced those beliefs which we used to read in books, and today we understood those in detail. Thank you so much for your time. Stay safe and take care, and wishing you and your family and everyone at Nippon Mutual Fund a safe stay. Thank you.
Thank you, and always a pleasure. Thank you very much.